Most people believe that when a country collapses financially, it is because of corruption, bad leadership, or simple mismanagement. But what if that is only half the story? What if some nations do not just fail? What if they are slowly, structurally, financially redesigned? Not with tanks, not with soldiers, not with invasions, but with contracts, with loans, with signatures. In the modern world, control does not arrive wearing a uniform, it arrives wearing a suit. After World War II, much of the world was in ruins. Europe was destroyed, currencies were unstable, trade systems had collapsed. Out of that chaos, a new financial order was born. In 1944, representatives from 44 countries met in Bretton Woods, New Hampshire. They did not gather to fight. They gathered to build a new global financial system. Two institutions were created, the International Monetary Fund and the World Bank. On paper, their mission was simple: stability, reconstruction, development, help countries manage crises, provide loans when economies collapse, prevent future depressions. It sounded noble, and for many nations in the early years it was. But something subtle began to happen over the decades. The institutions that were meant to stabilize the world started to gain leverage over it. Because when you lend money to someone in crisis, you do not just offer help, you gain influence. Imagine a country facing collapse. Its currency is crashing, inflation is exploding, investors are fleeing, people are protesting in the streets. The government needs dollars, immediately. Without them, it cannot import food, it cannot pay debts, it cannot stabilize the currency. That is when the IMF steps in. It offers a loan, but not a gift, a loan with conditions. And those conditions are never small. Cut public spending, reduce subsidies, privatize state companies, open markets to foreign investors, remove trade protections, restructure your economy. Now pause, think about what that means. A sovereign nation, an independent country, forced to redesign its economic system under pressure because it needs emergency cash. This is not military conquest, this is financial leverage, and leverage is power. Throughout the 1980s and 1990s, this pattern repeated again and again. Latin America, Africa, parts of Asia. Countries facing debt crises were given what were called structural adjustment programs. The phrase sounds technical, harmless, but the effects were massive. Governments were required to cut healthcare, cut education, lay off public workers, sell national assets, utilities, oil companies, telecom networks, sometimes to foreign corporations, sometimes to private investors. Entire national industries were sold off during moments of weakness. It was presented as reform, modernization, efficiency. But to many citizens inside those countries, it felt different. It felt like control. Here's the critical shift. When a country depends on foreign loans to survive, its policy options shrink. Decisions are no longer purely domestic. They are negotiated, conditioned, supervised. If you do not follow the program, the next tranche of money does not arrive. Markets panic, currencies collapse further, the pressure increases, so governments comply, not because they want to, because they have to. Over time, something changed in global politics. Power stopped looking like empire and started looking like dependency. Countries were no longer colonized by flags. They were bound by debt. Now, this is not a simple villain story. The IMF and World Bank argue that many reforms were necessary, that inefficient state systems had to change, that inflation had to be controlled, that corruption had to be addressed. And in some cases, reforms did stabilize economies. But here is the deeper question. Who decides what reform looks like? Who defines what is efficient? What is responsible? What is modern? And what happens when the same institutions advising countries are also influenced by the most powerful economies in the world? The IMF voting structure is based on financial contribution. The largest contributors have the most influence. The United States holds the largest voting share. Europe collectively holds enormous weight. Poor countries borrow. Rich countries vote. That imbalance shapes outcomes, subtly, quietly, systemically. Over decades, a pattern emerged. Countries borrow. They implement reforms. Foreign capital enters. Assets are purchased. Profits flow outward. Debt remains. And when the cycle repeats, more borrowing follows. It becomes a loop, not always intentional, not always malicious, but powerful and persistent. By the late 20th century, critics began to call this system a new kind of empire. Not territorial, financial. An empire without borders, an empire without soldiers, an empire of spreadsheets, of policy frameworks, of loan conditions. And the most fascinating part, most people living inside powerful economies rarely see it, because the system feels invisible. It operates in conferences, in economic reports, in quiet negotiations behind closed doors, yet its impact can determine whether a country rises or remains trapped. In the late 1990s, Argentina was called a model student of the global financial system. It followed the rules, it opened its markets, it privatized industries, it tied its currency to the US dollar, it accepted IMF programs. Investors loved it, money poured in. For a while everything looked stable, But underneath the surface, something dangerous was building. By fixing its currency to the dollar, Argentina gave up control of its own monetary policy. It could not print money, it could not adjust exchange rates, it could not respond flexibly to shocks. When global conditions changed, Argentina was trapped. Exports became expensive. Debt became harder to pay. Unemployment rose. Growth slowed. By 2001, the economy was collapsing. Banks froze accounts. People could not withdraw their savings. Businesses shut down. Protests filled the streets. The government begged for help. The IMF offered loans, again, with conditions: more austerity, more cuts, more reforms. But this time, the medicine made the patient weaker. Public services collapsed. Poverty exploded. Trust disappeared. Eventually, Argentina defaulted. The largest sovereign default in history at the time. Millions of lives were shattered, not because of war, because of financial architecture. Now look at Greece. After the 2008 global financial crisis, Greece was drowning in debt. Banks were failing. Bond markets collapsed. Interest rates exploded. Without outside help, the country would go bankrupt. The European Union, the European Central Bank, and the IMF stepped in. They formed what became known as the Troika. They offered massive bailout packages in exchange for strict reforms: cut pensions, reduce wages, fire public workers, raise taxes, sell public assets, ports, airports, utilities, entire sectors. The Greek economy shrank by more than 25%. That is depression-level collapse. Hospitals ran out of supplies. Young people immigrated. Suicide rates rose. Families lost everything. Yet debt remained. Year after year, payments continued. Control over economic policy moved outward. Greek budgets were reviewed by foreign officials. Before being approved, democracy remained, but sovereignty weakened. Now look at Greece. After the 2008 global financial crisis, Greece was drowning in debt. Banks were failing. Bond markets collapsed. Interest rates exploded. Without outside help, the country would go bankrupt. The European Union, the European Central Bank, and the IMF stepped in. They formed what became known as the Troika. They offered massive bailout packages in exchange for strict reforms: cut pensions, reduce wages, fire public workers, raise taxes, sell public assets, ports, airports, utilities, entire sectors. The Greek economy shrank by more than 25%. That is depression-level collapse. Hospitals ran out of supplies. Young people immigrated. Suicide rates rose. Families lost everything. Yet debt remained. Year after year, payments continued. Control over economic policy moved outward. Greek budgets were reviewed by foreign officials. Before being approved, democracy remained, but sovereignty weakened. But by the time failures became obvious, the damage was done. And accountability was rare. No elections, no recalls, no consequences, just reports and new programs. The system moved on. Here is the uncomfortable truth. Global finance created winners and losers, power concentrated, decision-making centralized, local autonomy eroded. And once a country entered the debt system deeply enough, escaping became extremely difficult. It is like quicksand. The more you struggle, the deeper you sink. In the early 21st century, something changed. The old system of control through emergency loans and austerity did not disappear, but it evolved. It became quieter, more technical, more invisible. Instead of dramatic defaults and street protests, power began moving through spreadsheets, algorithms, and central bank balance sheets. After the 2008 global financial crisis, the world faced collapse. Banks were failing. Credit markets froze. Trade slowed. Entire economies were about to shut down. Governments panicked. Central banks stepped in. They printed trillions of dollars. They bought government bonds. They bought corporate debt. They rescued financial institutions. This was called quantitative easing. To most people, it sounded boring, technical, harmless, but it changed everything. For the first time in history, central banks became the largest players in global markets. They were no longer just referees. They were participants. They decided which assets survived, which companies lived, which markets recovered, which ones died. Money flowed first to banks, then to investors, then to asset owners. Stock markets exploded. Real estate prices soared. Wealth concentrated. Meanwhile, wages stagnated. Living costs rose. Debt expanded. A new form of inequality was born, not between countries, but inside them. Now layer technology on top of this. Payments went digital. Banking moved online. Cash usage declined. Surveillance increased. Every transaction left a trail. Every purchase created data. Every financial move became traceable. At the same time, governments began experimenting with central bank digital currencies. Digital versions of national money, controlled directly by central banks, programmable, trackable, instant. Supporters said this would improve efficiency, reduce crime, lower costs. Critics warned it would create unprecedented control. Because if money becomes fully digital and centralized, whoever controls the system controls access to life itself. Food, housing, transport, healthcare. Everything flows through money. Now imagine that system linked to political compliance, carbon credits, social scores, sanctions, emergency powers. It already exists in pieces in different countries in different forms. The infrastructure is being built, quietly, gradually. Meanwhile, global institutions did not disappear. The IMF, World Bank, BIS, OECD, they adapted. They shifted from crisis lending to policy coordination, from emergency response to long-term governance. They began shaping tax rules, climate finance, digital regulations, debt restructuring, trade standards, all behind closed doors. With limited public oversight, national governments still exist. Elections still happen. Flags still fly. But financial sovereignty has weakened. Budgets depend on markets. Markets depend on central banks. Central banks coordinate globally, which means real power operates above national politics. This is why modern crises feel different. During the pandemic, governments shut down economies overnight, then issued massive stimulus, then increased debt, then relied on central banks. No parliamentary debates, no long deliberations. Decisions were made in hours by small groups of officials for survival, and once emergency powers expand, they rarely shrink completely. History shows this again and again. Now look at developing countries today. Many are deeper in debt than ever. Rising interest rates are crushing budgets. Climate disasters destroy infrastructure. Capital flees at the first sign of instability. Currencies collapse. Food prices spike. And once again, emergency programs return. With conditions, with oversight, with reforms. The cycle continues, only faster and more complex. Here is the core reality. Modern power is not held mainly by armies. It is held by networks, financial networks, legal networks, technological networks, regulatory networks. Whoever controls these systems shapes outcomes without firing a shot, without declaring war, without appearing on the news. This is why financial history matters, because it explains why some countries struggle no matter how hard they work, why inequality keeps rising, why crises repeat, why promises of reform often fail, and why freedom in the modern world is deeply connected to economic independence. Now ask yourself something. Who controls your money? Where it flows? Who can freeze it? Who can tax it? Who can inflate it? Who can devalue it? Who can block it? Most people do not know, and that ignorance is part of the system. Because power works best when it is invisible, when it feels inevitable, when people believe there is no alternative. But history shows something important. Systems change, empires fall, financial orders collapse, new models emerge. It has happened many times before, from Roman coinage, to medieval banking, to colonial trade systems, to gold standards, to fiat money, to digital finance. Nothing lasts forever. The question is not whether this system will change. The question is who will shape the next one, and whether ordinary people will have a voice in it, or whether it will be decided entirely by institutions and algorithms. If you want to understand the modern world, if you want to understand power, if you want to understand why things feel unstable, why money feels uncertain, why trust is disappearing, you have to understand finance. Not as numbers, but as history, as politics, as human behavior, as struggle, as control, as opportunity, and as risk. This channel exists to uncover these hidden systems, to connect past and present, to explain what most people never get taught. If you found this story valuable, if it helped you see the world differently, make sure you subscribe, because the next videos go even deeper into empires, into crises, into secret systems, into forgotten decisions that still shape your life today. And together, we are going to map the real history of money and power.